If you ask what the secret of sound investment is, Benjamin Graham gives you two words: margin of safety. Everything in this chapter, and much of the book, hangs on that idea. The margin of safety is simply the cushion between what you pay and what the business or bond is really worth. It's what keeps you from being wiped out when the unexpected happens. Start with bonds and preferreds. Here the margin of safety is easy to picture. How many times has the company historically covered its interest and dividend obligations? Graham gives the classic railroad example. Bonds should ideally have had interest coverage of about 5 times before taxes. That past coverage creates the cushion you need if earnings fall. Another way to see the same thing is by comparing enterprise value to debt. If a business is worth $30 million and owes $10 million, you have room for a big fall in value before bondholders suffer. Can the same idea be used for common stocks? Absolutely, but it looks different. Graham cites cases like depressed times in 1932 to 1933 where such bargains existed. But there are 3 important cautions. First, price matters. The margin of safety depends entirely on how much you pay. The same company can be a safe investment at one price and a speculative bet at a higher price. Paying too much destroys the cushion. Second, past earnings are not the same as earning power. You must test earnings across a number of years, including bad years. Buying small, second-rate companies simply because they had 2 great years during a boom is a classic way to lose money. Fair-weather winners often reveal themselves as fair-weather only. Third, growth investing substitutes estimated future earnings for past records, which is fine in theory, but only if your projections are conservative. The market often prices growth stocks so high that even a cautious forecast gives no margin of safety. In practice, that's where many growth investors get hurt. Graham then connects margin of safety to diversification. Even if you buy bargains, any single holding can fail. But if each position carries a margin and you hold a diversified group, the math favors gains over losses. Think of it like insurance. Diversification turns a gamble into a business. He also uses a vivid roulette analogy. Betting $1 on a single number is speculation. No margin, big downside. But change the payoff or spread the bets and the arithmetic can flip to favor you. In investing terms, the right price creates that favorable arithmetic. Graham uses the margin of safety test as the dividing line between investment and speculation. If your case rests on demonstrable numbers, conservative reasoning, and historical evidence, that's investment. If it rests on hope, timing the market, or I know better than everyone else, that's speculation. He also extends the idea to unconventional situations. Deeply depressed bonds or obscure special situations sometimes become genuine investments because their prices create a large safety margin. That's why bargains are often found among securities the crowd has abandoned, provided you do the homework and diversify. The modern commentary that follows the chapter emphasizes the human side of risk. Risk is not just about volatility, it's about avoiding permanent loss. Pay too much and a temporary drop can become a lifetime scar. The bigger the initial loss, the longer it takes to recover. Graham's margin of safety is the investor's way of nailing fortune to the floor so she won't run away. A few practical examples and lessons. Buying overpriced story stocks at the peak of a boom. The dot-com boom examples are modern echoes. Shows how paying for excitement destroys the margin of safety. If price swamps value, even great growth won't save you. Growth stocks need conservative forecasting. If your projection of future earnings is optimistic, demand an extra cushion in price to compensate. Special situations and distressed bonds can be opportunities if price gives you room to absorb errors. The 1930s real estate bond story shows how securities that were once speculative became attractive investment plays after prices collapsed. So how should you act when you read Graham? A short checklist to read aloud and remember. 1. Know what you're buying. Treat every security like a business or a claim on a business. 2. Don't overpay. The margin of safety is your first line of defense. If it's absent, don't buy. 3. Use conservative numbers. When you project the future, err on the side of understatement. 4. Diversify. Even good margins can fail occasionally. Spread the risk. 5. Have the courage to act. When your analysis is solid, buy even if the crowd disagrees. When you're wrong, accept it and protect capital. Benjamin Graham ends with a business-like exhortation. Investing is a business. Run it with the same care as any enterprise you'd trust with your own money. Use arithmetic, not emotion. Demand a margin of safety every time. Do that, and when the world inevitably shifts and storms blow through markets, you'll be able to say calmly, "This too will pass."